if you have a large sum of money, should you use it to invest or pay off your HDB or mortgage loan first? Now, you see, most Singaporeans, they are taught this one thing when they are growing up, that is to be debt-free. And that means paying off your mortgage loan or HDB loan as fast as possible. Emotionally, it feels responsible. But in 2026, these decisions might have cost you thousands of dollars. And you would realize by the end of the video that the biggest CPF mistakes are emotional, not mathematical. For those of you who are new to the channel, my name is Chris Chong and I run a Telegram channel of over 22,000 members, and you can join like-minded people for free and chat about your finance problems. But before we go into the specifics, let's talk about the default situation for many of us, or for most of us, right? We talk about HDB loan, because HDB loan is what most people start with when they are buying their HDB and they go through a housing loan, and is currently charging 2.6%, which is 0.1% above the CPF OA interest rate. So you see, it's kind of like an offset, right? You borrow 2.6% from HDB, and then at the same time, you gain 2.5% per annum in your CPF OA interest every year. And at the face value, you would think that you would net a 0.1% savings by using your CPF to pay down your HDB loan at 2.6%, right? It's almost the same. And many people would do that to save that 2.6% interest, because they are just taking out money from their CPF, which feels really harmless, it's not hurting their cash balance at all, to pay off a 2.6% loan. So to them, they don't owe HDB any money anymore, and hence they feel debt-free, and hence have the peace of mind. But this comparison is incomplete because it assumes that your home loan rate stays the same forever. And for the context, this video is sponsored by Cashew, but more on them later. Okay, coming back to the perspective of loan ownership, let's discuss why using CPF to pay off your home loan is not free, right? Even if you choose to pay down your home loan, do you realize that your CPF stops earning that 2.5% interest because it is already gone? It is used to pay off the housing debt. But not just that, you have to remember that the CPF that you have used to pay off your housing loan is now accruing interest at 2.5%, right? Remember the concept of accrued interest? And when you sell away your flat, remember that from the sales proceeds, you have to return back to CPF the principal plus any form of accrued interest that you have used to pay off your housing loan. So did you realize that you are not escaping debt? You're just moving this debt from HDB or your bank loan to your CPF account as a form of accrued interest. Of course, whether accrued interest is your money or not, that one we should discuss in another topic. But you have to realize that it's not really like real debt-free or peace of mind. It's just a transfer of debt ownership. So my message to everyone is that before you dump your life savings into your mortgage or home loan, you need to check if you're overpaying for your debt. HDB loan was great during high interest periods like in 2022 to 2024. But what about in year 2026, in the current low interest rate environment? What can I do to save more money on interest? This is where a mortgage broker like Cashew comes in. Because if we look at the current bank rates in 2026, many bank loans are sitting well below the HDB rate. For example, a $500,000 loan over a 20 years tenor, you could be saving over $3,000 per year by switching from HDB loan to bank loan. I have personally used Cashew to refinance my mortgage from HDB loan to bank loan last year, and that was really because Cashew allowed me to compare all the latest rates across the different banks instantly and transparently. And did you realize that by lowering your loan rate to, let's say, 1.5%, the argument for paying it off early actually disappears? Because why would you rush off to pay off a loan that costs you less than the CPF interest is giving you at 2.5% per annum? That 2.5% paid to your OA every year is as good as passive income. And if you're using it to pay off a low-cost loan, then what's the point? So let's share some features that I really like about Cashew. Like on the platform, you can see the loan rates transparently before even providing your contact information. So for those of you who would like to see, look first before you buy, this is the platform for you, right? And Cashew even have a best rate guarantee where you will ensure you get the lowest rates. Terms and conditions apply. And they also have a WhatsApp AI chatbot providing mortgage-centric advice that you can learn from. And just to be clear, there will also be legal fee subsidies so that it can incentivize you to take action. So don't wait anymore, right? You can either use my exclusive link here or just check out the page, right, to see what is the best loan offers in the market right now. And I'm very sure nobody here wants to pay more interest than they need to, right? So start taking action and look to your HDB loan refinancing to bank loan using Cashew now. So far, I only covered the loan aspect. Let's talk about something else, right? What are two paths of your CPF if you have a large amount of CPF suddenly in your ordinary account? The number one path is that most people, you will use that CPF to pay down the HDB loan, right? And what are the benefits is that you save that 2.6%, assuming it was the HDB loan, right? But then if you refinance to a bank loan, it may be much lesser than 2.6%. So you have to weigh the benefit. But by using your CPF to pay off the home loan, you realize that you are giving up that 2.5% that CPF OA is going to give you passively every year. So if you look at the net savings, it is at 0.1% because 2.6% interest from HDB loan, 2.5% guaranteed OA interest every year, offset 0.1% net savings. And you realize you have no debt with HDB, but you will still have accrued interest calculations that you are owing to CPF. Now let's look at the second part. What if instead of paying off your HDB loan, this CPF, you use it to invest it properly, which is what I have done for my situation. Firstly, I use Cashew to refinance my HDB loan to mortgage loan to keep it low at around 1 point something percent. Secondly, I use my excess CPF OA to invest in low cost unit trust options. And I do that through a traditional brokerage called Poems by Philip Capital, which offers zero sales charge and zero platform fee in the low cost unit trust. So the net effect for this second path is that you capture the spread between a low interest loan and the long-term growth of the stock market. In other words, this is an arbitrage opportunity using good debt like a housing loan. But this is of course assuming that you have the right investment risk appetite and you are able to stomach volatility of investing, because I still understand that many of you all may not have the risk appetite to stomach all this like volatility up and down of the stock market. Now, personally, I have been investing my CPF OA since 2021 and it has netted me much more returns compared to what the OA interest of 2.5% was giving me every year. And this is even after going through that 2022 market crash when S&P 500 fell by double digits that year. But don't get me wrong, I can totally understand that investing is really not for everyone. But if you ever decide to invest, then you have to remember that cost control is everything. And I'm currently using Poems because they offer a monthly funds, which are the low-cost unit trusts like the Money Prime USA or Money Index World MSCI fund with no sales charge or platform fees. So I could just buy once and hold them forever without any form of recurring costs other than the expense ratio. So remember that CPF is long-term game and fees compound negatively as well. So by using a low-cost broker, more of your retirement funds can stay invested. And you can also check out the link in the description if you want to get started with CPF OA investing by Poems. So if I were to summarize my ultimate HDB repayment strategy, it is only two basic steps. Number one, switch to a low interest home loan. Okay, you refinance it to a bank loan, and my mortgage broker of choice is using Cashew because that was what I used. I checked the rates transparently and then I contacted their broker to help me with the refinancing. And that will reduce your cost of debt even lower. My second step of the strategy is to use my excess CPF OA funds, other repayment, to invest in assets that historically beats CPF OA 2.5% interest rates. So remember, it's only just these two simple steps. Number one, reduce the cost. Number two, increase the potential revenue or income, right? 开源节流, right? Reduce the cost, increase the revenue or income. But I want to remind everyone here that this is just what works for me. It may not work out for you because past performance is not the guarantee of future results. And by the end of this video, I hope you remember that paying off your HDB feels really safe. You think you have a peace of mind. But in 2026, safety without math is expensive. Don't treat your retirement fund like a short-term debt tool. Let the math work out for you. And if you enjoy such property plus finance related videos, go and comment property plus one. I'll do more of this finance analysis with regards to property context. And if you want to watch my previous video where I talk about property versus stocks, which one will earn you more money in the long run, then check out this video right here.